Portfolio Builder members, welcome to our Friday trade alert where we trade the SPY. Poor Trump is having a rough day today. We'll go over the news and our new trade alert. And despite him getting a little upset with the Jackson Hole speech today from Powell, which I thought indicated he's ready to cut rates, and the market initially was rallying on the news, Trump came out in response to China's tariffs and the devaluation of the currency, which I was watching last night, and says he has an important announcement at the market close today. That sent the SPY cratering lower, and I think we're about at the bottom of that. And I'll show you why in a minute. Let's just pull up the chart really quick to take a look. If we go into a closer look, we can see the market was having a great time with the indication that the Fed would be ready to lower rates, and now surely they will. But after that Trump tweet came out, we had the market completely plummet, and now we're all on edge to see what the news is this evening. We'll take a look at the exact tweets. Quick review of the trade alert. Thank goodness we had our put protection. The most recent trade alert was this one right here, where we had sold the 295 call for 57 cents and used that to finance a put option, which came in very handy today and helped significantly reduce the losses of this really unexpected sell-off. And so we were able to buy the put option pretty much for free by selling that 295 call. So this definitely paid off today in terms of reducing losses. The SPY would have lost 528 all on its own, but our option caller reduced that loss by $2.10, bringing our net loss down to $3. Overall, it took about 1% off the total portfolio. But when you look at how we allocate our total capital, the bond portfolio and precious metals portfolio is kicking ass today. So actually, overall from this movement, we're doing just fine and dandy. If we look at the total return, when you balance your portfolio as we have, we're still sitting on a 1.3% return in August, which is quite remarkable. Considering many people probably just lost upwards of 2 to 5% of their total assets in the last trading hour. Now, I have been telling everybody that of all the positions, the bond portfolio and gold portfolio was the easiest to predict, but the equities portfolio is the most difficult, and so it's still sitting on a 0.3% return in August. I was expecting all this volatility to begin in July, so we were about 50 days early, I guess, in terms of predicting that tariffs and the China trade war would escalate. And here's why I think we may have a sharp rebound to close out the day. I'm not saying this will last, but our current trade alert essentially just bought a put option at 286.50, so it cuts off our losses at that if we do sell off more. But what I'm really interested in is that there's a huge amount of underwater put option writing. So there's a bunch of people who sold put options and they have not covered their position yet. That means they have to convert these open positions into purchasing the SPY. And I believe when that happens, and it does have to happen today, we will see a tremendous rally in the SPY. Now, will they hold on to their shares after they do this, or will they dump them? That's the question. So if we look at the underwater put options right now, I added it up just a few minutes ago. There was about 150,000 contracts, which represents around a $5 billion buy order for the SPY. And they're just sitting there waiting on closing out these positions. So I suspect that they're going to let all the selling occur. These are the big banks who underwrite these positions because this represents billions of dollars. And at some point, they're going to have to cover these positions, and that's going to represent a massive buy order for the SPY. So I do think our opportunity to short the SPY could have been missed. We did have that put option protecting us into today, and our new trade alert simply bought a put option underneath the SPY and sold no call option. If we do get a remarkable rally because of this covering of the short puts, I don't want to miss out on some of the potential profits. So we bought a rather expensive put option today at the 286.50 level. So right now that's trading at 80 cents. And when they cover, we'll see. Are they going to hold on to their shares into the weekend and risk whatever it is President Trump has to say at the market close today? Or are they going to dump those shares and start shorting the market? Now, the whole system's really leveraged to go up, not down. When it goes down, this creates all sorts of problems. So we'll be following the news on this very closely. Currently, I do think we missed out on the opportunity to bet down, and that's why our current trade alert will profit very well if the market travels higher. On the other side, our bond position and precious metal positions are doing very well today, and again, helping balance out the total portfolio so that we actually made money, surprisingly. So, quick review of the trade. To get out of the previous trade, you need to buy to close your 295 call. For a debit of 1 cent, we collected something like 55 cents on that, which we used to buy our put option. So we got a free put option out of this trade, which is always nice because that put option went up in value and it actually went up about 220%, closing it out for a credit of 219 right now. The new trade is to buy to open the 286.50 put, and when I took the screenshot, that was just right at the money. Currently, you can buy that same put for significantly less, and here's what our profit looks like. The risk is essentially the cost of the put option, and the potential gain is just however high the SPY travels from here. We're going to lose the value of the put option, most likely if the SPY does rally hard after this sell-off. So exciting times. It's important to have that very well balanced portfolio right now. And so if you're not following all of our trade alerts, you're starting to realize how hard it can be to predict the minds of Trump and Xi, and why it really makes sense to allocate your capital 40% into stocks, 40% into bonds, and 10% into those precious metals. So just a quick overview of our strategy here. If you do follow our program in full, which I highly recommend because it does make your portfolio rather weatherproof, the trade allocation per 100,000 is recommended to be 100 shares of the SPY. Now our Tuesday play will most likely, depending on how bad the news is from Trump, we may flip this to playing the silver during times of aggravation. I want to be long silver in the Tuesday play, and this is with the option caller, so we're not just writing it naked, trying to turn these into income generating assets for retirement, and then 200 shares on the TLT. Meanwhile, on our buy and hold portfolio, it is 50 shares of GLD and a fourth of a Bitcoin. And this is based on a $100,000 portfolio. So this will end you up with about a 50% position in equities, 40% in bonds, and then 10% in precious metals. And if you're not upgraded yet and you're missing out on some of the trades, I think you're starting to see how important it is to not be all in on a single asset class. Unless you're some sort of crazy day trader, your life can be made much easier by simply following our trade alerts that diversify your portfolio to own bonds, precious metals, plus stocks. So again, call Dean for special pricing, 505-322-7515. He'll get you upgraded. You'll get our full set of trade alerts. And if you're losing money today, you got to ask yourself, what could happen in the next 3 months if the U.S. and China relations deteriorate further? Are you protected to the downside on equities? Do you have a strong bond position? And what could unravel the bond portfolio which is turning into one of the greatest bubbles of all time. So our strategy is very well balanced, and there's little risk to either gain or lose a lot during any period of time because all of our assets have a put option below it, including in the bond portfolio. So let's jump into the news today and look at why I think there's some exciting times ahead and what our market predictions are moving forward. And we have 11 watching now. Do remember you have a live chat, so you can say hi, and we'd love to get some communication and interaction going. And if you see the live chat, I just said please say hi here and let me know who's on. I'd like to get a lot more interaction going on in these live streams. And all right, with that said, a lot of these screenshots we're taking right before the Trump tweet came out. So you can see we're sitting at 292 on the SPY. It actually had gone up to 290.50 when I was about to take screenshots of our profits on the SPY. And then we got that Trump tweet. Now, depending on how aggressive Trump is in his speech today, we'll have to decide what to do with the equities portfolio. I think it's quite clear. Bond market is now going to travel significantly higher into new highs. I think it's clear the Fed will have to lower rates, even though they're a little wish-washy today. And as long as this chart right here on LQD, that's the investment grade bond portfolio, remains intact, I still think we have to be relatively long equities. Now, I know this big sell-off is scary, but at the end of the day, the tariffs the Chinese have put into place really don't make a huge impact on U.S. Exporters because we just don't export much, and they already cut off the agricultural products. So what exactly are they going to put tariffs on? The more concerning thing perhaps that I believe was really upsetting Trump, let me get down to it, is this chart right here. And Dean and I were actually watching this unfold last night. If you remember yesterday, I was kind of perplexed why the Chinese equities were selling off so hard relative to everything else yesterday. And then last night we watched the Chinese yuan crack the 7.1. What's going to happen if this travels up to 8 or 9? Holy cow, that's going to create a lot of outflows out of China and could create a sort of like a domino effect. If the Chinese devalue their currency, then guess what? All the neighboring countries are forced to lower their currency. Otherwise, it makes trade unfair. And so this could continue to push the dollar higher and higher, and which makes, of course, U.S. exports more and more expensive. And this is primarily what's been upsetting Trump so much. Now, good news is he did get a little sell-off today, a tiny bit, but I suspect until the Federal Reserve does dramatically drop rates, this is going to push higher and higher as all these different countries are forced to lower rates, devalue their currency to offset the effects that the Chinese are creating. So fascinating time to be watching the markets. Meanwhile, the best indicator for predicting the moves of the Fed, quite frankly, you might want to ignore whatever they put out to the public, because the last thing they want to do is scare everyone and tell the truth. But the German bond yield has been in a free fall. There's been a tiny little pickup, but this is certainly to continue the downtrend as long as the trade war escalates. And in a minute, I'm going to show you the written speech of Jerome Powell at the Jackson Hole today, which I thought was very good and very bullish for stocks. Now, the caveat is the market is super sensitive to trade war scares. But from my point of view, we now have free money floating around the world. We're going to see more pressure applied to China and emerging markets. And we're going to have interest rates getting dropped, potential support of the bond market. To me, this all points to potentially the bubble expanding. And the big caveat for equities is whether or not how aggressive these two countries go at each other in the trade war front. So I think potentially we could have a nice ride in the SPY despite the sell-off today. And we'll see what happens. Are the people who are going to cover their short puts today, which represents about $5 billion of purchasing, are they just going to dump those SPY shares, or are they going to hold on to it? So that's kind of the interesting thing going on here. Here is Donald's quote. As usual, the Fed did nothing. It was incredible that they can speak without knowing or asking what I am doing, which will be announced shortly. We have a very strong dollar and a very weak Fed. I will work brilliantly with both, and the U.S. will do great. My only question is, who is our bigger enemy, Jay Powell or Chairman Xi? And so again, I thought his speech was relatively dovish and setting the stage to actually lower rates. Here was some of the highlights of it. We will act as appropriate to sustain the expansion. The economy is in a favorable place, faces significant risks. Events since the July FOMC meetings have been eventful. Well, now they're really eventful. Powell carefully watching development for impact on U.S. monetary policy, has no rulebook for international trade. We've seen further evidence of a global slowdown. Well, that's about to expedite. And Powell cites Brexit, Hong Kong weakness in Germany and China as key risks. And then the news this morning that China's tariffs are putting a 5 to 10% tariff on various goods. But as I said, a lot of these exports from the U.S. to China are already relatively small and have been getting greatly reduced from their reaction to the initial announcement. So it does look like the Chinese are ready to decouple with the U.S. and see what they can do to push United States into recession. They want Trump out, as it is definitely causing some major pain in their economy. News about the Hong Kong going on. First we saw Facebook and Twitter ban a bunch of Chinese accounts relative to the Hong Kong and the CCP. Now we saw Google make some bans, and so things are certainly escalating. Based on what I know, China will take further countermeasures in response to the U.S. tariffs on 300 billion Chinese goods. Beijing will soon unveil a plan of imposing retaliatory tariffs on certain U.S. products. China has the ammunition to fight back. The U.S. side will feel the pain. So I don't really see where they have the ammunition to fight back. Really, the only thing they can do is continue to devalue their currency. And this is going to create quite a shockwave in the emerging markets, as it will force other countries to essentially devalue their currency. So the clear picture for the bond market going higher is really stronger than ever, and the reasons to be long gold would appear to be better than ever. And in fact, we did buy some call options on the ticker GOLD yesterday and significantly added to our gold position. So good timing on that. And depending on what we get out of the speech from Trump this evening, I may be ready to significantly increase our gold position. Now that's one hell of a risky position. Market cap in gold is something like $6 trillion, which is peanuts compared to the $40 trillion stock market and now the $240 trillion bond market. So when you look at all the money that's floating out there, and now we're going into a period where money is essentially going to be free to borrow in most of the world, and they're going to be potentially motivated to only buy U.S. stocks because the picture for emerging markets is deteriorating. It's going to be very hard to predict the U.S. stock market, but it looks like it could have a huge boom of money flowing into it. This was an interesting interview last night that hit. He teased about it a week ago, that he had been involved in the setup of the Trump meeting with this lady, as well as potentially blackmail against Hillary Clinton. And he's essentially saying that there's three big dogs that are running a kind of a secretive group in the FBI, and that he was helping them. And so this is very interesting. We'll see what comes out of it. At the same time, we're having this Epstein case. So there's a lot of mysteries going on in politics right now, domestically, that I'm trying to keep a close eye on. That could be another potential earthquake for us. The U.S. has gone to great lengths to suppress China, but the damage actually caused is much less than we were worried about. People who were fearful of the U.S. no longer feel so. Trade war is bad, but we're doing well. I'm not sure if that's really true. We've already seen 3 Chinese banks go under. We're seeing them devalue their currency. They potentially lost their relationship with a huge European bank, HSBC, which perhaps was the one who was keeping their currency afloat and funding it. So if they're running out of capital and are over leveraged, China could potentially go bankrupt here. So very interesting time. Now we do have some, this is hilarious. We do have some put options on FXI, so good luck on those turning a huge profit next week. And we'll continue to play this basically long America, short China concept on our Tuesday trades. So let's take a look at some of the highlights from the Federal Reserve speech today, which again, if you go to the description box, you can get the link to all this content, including these YouTube videos. I picked out really just a handful today. So one, we have the Fox News interview, and then immediately after he came on to CNN, so you can see how the 2 different media branches go about the same interview. Of course, the implications were really, if you listen to him, not this sort of visual whatsoever. And then this is a good interview with Steve Bannon about what's going on with China, what he thinks is going to happen with China, and how it relates to Hong Kong. So great interview there. Okay, so let me go up to the speech. And again, if you want to read it in detail, you have a link. Okay, so this was his speech. It wasn't publicized on the TV, so there's only a written speech that was passed around. And he goes through, basically, if you want to boil it down, he says there's been 3 great periods. And so the first great period was right after the World War II, and this is where he says we essentially went into a period of creating too much debt that eventually ended with hyperinflation, which we've studied on our videos time after time again. And then Paul Volcker came in and jacked the rates extremely high, almost up to 20% on the federal fund rate, and put an end to hyperinflation. And so the start of his speech talks about how great America's doing, how we've had the record long expansion. Minorities are showing low unemployment rates. We're seeing most of the income increases happening at the lower end of the economy. And that inflation has been surprisingly stable during the expansion, not falling much when the economy was weak, but not rising much. Thus, after a decade of progress towards maximum employment and price stability, the economy is close to both goals. Our challenge now is to do what monetary policy can do to sustain the expansion so that the benefits of strong job markets extend to more of those still left behind, and so that inflation is centered firmly around 2%. Now, a lot of people probably wonder, why on earth does the government want to create inflation? That means if you hold on to your dollars, they're going to lose value over time. In fact, that works out to about a 50% loss in your buying power every 17 years. And that's actually exactly the point. If there's deflation and people think that if they just hold on to their dollars, they'll become more valuable, well, are you going to go buy something today? No, you're not, because you think now that if you hold on to your dollars, they'll be worth more just by sitting on them. And so deflation can create an economy that just freezes and stops spending money, stops investment. So on the other hand, if there's inflation, now you have a reason to make that purchase right now and to make your investment right now. And so if you think of all the people being born, all the technology being created, this is representing more and more economic power for the country. And it's the central bank's job to try to figure out just how to represent that with money. And so their job of increasing and decreasing the interest rates and buying up government debt to increase the monetary supply can be a tricky little job. And we've seen that they have not successfully been able to stop the market cycles and to not have huge fluctuations in unemployment and the value of the dollar. And so certainly they do their best, but if you study all these central bankers over the past since World War I into current day, a lot of them will end up saying at their deathbed that with everything they did, they didn't think they actually made a difference and that the world just kind of worked out the way it would. So there's a lot of great books out there to study that. If we do go into more of his speech, though, he breaks it down into 3 great periods. The first was one that ended up with hyperinflation going into the 60s, 70s, and 80s. And this was a period of time where the government created tons of subsidies for its people, safety nets, started up all sorts of things like Medicare, Social Security, and created a huge amount of debt, and ended up with one of the worst bear markets of all time. And perhaps that's what we're headed into at this point in time. Now, if we do pull up the Dow over that period, let me pull up the photo. So put some context into these periods of time he's discussing. So this only goes back so far, but this is where we had the hyperinflation and where we ended up having to jack rates all the way up to 18%. So imagine if that sort of trend began to occur in our bond market currently. It would absolutely put the governments into bankruptcy because they would have no way to borrow and pay interest rates that high. Now we got a question. Howard says, if you expect a rally at the end of today, why are you buying a put option? Howard, I always buy a put option, and that's because I don't want to wake up one day and have lost 10, 20, 30 bucks on the SPY because a huge sell-off. And also, we don't know what exactly Trump's going to say this evening, so that's a big unknown. On the other hand, I don't want to sell a call option after such a significant sell-off when I know that everyone needs to cover this position at some point today. The big question is, will they hold on to those SPY shares or are they going to dump them? And so let's see how it's... So far it looks like people are starting to cover and the sell-off has started to stabilize. We're set up to potentially make a profit being long the SPY right now, but if we're wrong and the SPY were to continue to collapse, we're not going to lose much. So that's why we want to own that put right now. And if we do take a look at the open interest still, let's see what we're looking at. So the people who wrote the put options, that's your big Wall Street banks, they have to have all the capital to buy these shares at these prices. They're really just sitting on these positions right now. So I'm suspecting that they're going to come in, buy a lot of SPY, and then cover the position potentially for a profit if they can push the price up above these different levels. So there seems to be good economic reason for the underwriter at this 290 strike specifically to do their best to manipulate the SPY up above 290 and then cover all these short positions. Now, what happens after he gets out of that losing trade, I don't know. And that may have a lot to do with what happens with the Trump speech. And again, that's why, we went over this in the last webinar. It's incredibly important that you have a balanced portfolio, and that's why we actually have a profit today. We actually went up about 0.2% today without touching anything. Even though the SPY lost, the bonds went up. And so usually bonds go down, SPY goes up, SPY goes up, bonds go down. In general, they're traveling higher together. So again, if you're not upgraded and following the full program, you're missing out on some pretty easy profits by simply having a well-balanced portfolio right now. Okay, so let's go back to... So he essentially says we've had 3 big periods. One was marked with hyperinflation and ended up with the Fed having to raise rates significantly. And that's this period here. If we look at it in the Dow, you can see we're sitting on this huge bubble, and it was fueled by government spending. So in the short term, the government creating debt really isn't a problem. So we have these huge deficits coming out of the U.S. government right now, and we have super low interest rates, so they can borrow for cheap, and they push this money through the economy, and guess what it does? It gooses up the profits of the companies, it gooses up the profits of everything, and the debt just kind of gets swept under the rug. And what causes this to change? Really, the only thing that seems to make the Fed react is when we get inflation. And so we finally, after creating tremendous amounts of debt during this whole period, creating lots of safety nets, this is after getting out of the Great Depression. We had a bunch of presidents come in saying we need to take care of the people, and essentially they just started handing out money for free and creating a huge debt level. Eventually, all the money printing ended up with inflation. And so I'll go up to the inflation chart now. And so it took a while for the inflation to hit, but the stock market was the first to predict it. And you can see the top of the bull market was right here in 1966. And so if you had been overly bullish in 1966 and were just long equities, you had to wait till 1995 to break even. And so we can see right here, right after 1965, that's when all the inflation started to creep in and got out of control. In fact, we had an inflation problem all the way to the 80s, which was finally cut off as Paul Volcker pushed the federal funds rate up to 15%. So during this period, you actually couldn't be long stocks or bonds because both were crashing simultaneously. So this represented one of the hardest times in history to make a buck in the markets unless you knew how to short them. Now, from my point of view, I don't think we're quite at the end of the game yet. I think we're still something more like, let's go back to that Dow. I think we're something like in this 1963 to 64 range, and we're gearing up to push the bubble tremendously larger. And so there's no inflation to speak of. In fact, let's look at the current readout from the official stats. We had a little bit in 2018, and they jacked up the rates and sent inflation crushing lower again. So I think that's what's going to happen. All the central banks are going to lower to zero, print a ton of money, support their government debt, and eventually we will get that inflation that ends this whole big bubble. So definitely being careful, well balanced, and paying attention to these inflation numbers will be critical. So this marks the first great era. Let's go back to Powell's speech. It's a great speech. Today I'll explore what history tells us about sustaining long, steady expansions. A good place to start is with the passage to the Employment Act of 1946, which stated that it's continuing policy and responsibility of the federal government to promote maximum employment, production, and purchasing power. Some versions of these goals have been in place ever since. I will divide the history since World War II into 3 eras organized around some well-known greats. The first era compromises the post-war years through the Great Inflation. The second era brought the Great Moderation, that's your Bush, Clinton, Obama era, and the third era, which kind of segues into Obama, Trump here at the third era. The third era is still underway, and time will tell what greats may emerge. And I think we're going to see a repeat of the Great Inflation period in the upcoming years. So that will be fun if you know what you're doing. Each era presents a key question for the Fed and society more generally. The first era raises the question whether a central bank can resist the temptations that led to the Great Inflation. The second era raises the question whether long expansions supported by better monetary policy inevitably lead to destabilizing financial excesses like those seen in the Great Moderation. And he's talking about the housing bubble and the dot-com bubble. The third era confronts us with the question of how to promote sustained prosperity in a world of slow global growth, low inflation, and low interest rates. Near the end of my remarks, I will discuss the current context and the way these questions are shaping policy. Era 1, 1950 to 1982. And again, let's just look at our chart one more time so we know what we're talking about. Okay, 1950 to 1982. I want to pay attention to the federal fund rate was going up, up, up. The inflation was started off actually as deflation and slowly worked its way into massive inflation at the top. And you can see we had a tremendous rally. The stock market went up some from 1,800 to 7,200. The late 1940s were a period of adjustment to a peacetime economy. As the 1940s turned to the 1950s, the state of knowledge about how to best promote macroeconomic stability was limited. The 1950s and early 1960s saw the economy oscillating sharply between recession and growth, above 6%. 3 expansions and contractions came in quick succession. With the benefit of hindsight, the lack of stability is generally attributed to the stop-and-go stabilization policy as monetary and fiscal authorities grappled with how to best modulate and use their blunt but powerful tools. Beginning in the mid-1960s, stop-and-go policy gave way to too much go and not enough stop. Not enough, that is, to quell rising inflation pressures. Both inflation and inflation expectations ratcheted up towards 4 expansions until the Fed, under Chairman Paul Volcker, engineered a definite stop in the early 1980s. And that's when we hit the ridiculously high federal funds rate. Each of the expansions in the Great Inflation period ended with monetary policy tightening in response to rising inflation. Policy makers came out of the Great Inflation era with a clear understanding that it was essential to anchor inflation expectations at some low level, but many believed that central bankers would find it difficult to ignore the temptation of short-term employment gains at the cost of higher inflation down the road. Era 2, 1983 through 2009, the Great Moderation and Great Recession. All right, so let's just take a look at the big scheme during that period, and we'll jump into this piece. Okay, so here's the Dow in 1983. Up to 2008. So once again, we had a huge run up in asset valuations from 2,100 to 18,000, which is an insane gain. And look what happened to monetary policy during that period. we went from 19% federal funds rate down to 0%. And let's take a look at the inflation data over the same period. Just put this all into context. And so inflation came rocketing down from 10%, as high as 15%, all the way down to 1 to 2% by the end of this period. Until it came roaring up right before the '08 crash. We can see it's starting to really start to hype up in 2006, 2007, 2008. We got that housing bubble. As the second era began, inflation was falling, and it continued to fall for about a decade. In 1993, core inflation, which omits the volatile food and energy components, first fell below 2.5% and since remained in the narrow range of 0.9 and 2.5%. Greater success on price stability came with greater success on employment. Expansions in this era were longer and more stable than before. The era saw 2 of the 3 longest U.S. expansions up to that point in history. Anchored inflation expectations helped make this win-win outcome possible by giving the Fed latitude to support employment when necessary without destabilizing inflation. The Fed was cutting, not raising, rates in the months prior to the end of the first 2 expansions in this era, and the ensuing recessions were mild by historical standards. So we're talking about the dot-com bubble, which was about 1.5 years, maybe 2 years, and then the '08 crisis, where essentially we doubled the debt to get out of that crisis under Obama's watch, and that one only lasted a year. And twice during the long expansion of the 1990s, the Federal Open Market Committee eased policy in response to threats to growth. In 1995, responding to evidence of slowing in the United States and abroad, the FOMC reduced the federal funds rate over a few months. In 1998, the Russian debt default and the related collapse of the hedge fund long-term capital management rocked financial markets that were already fragile from the Asian financial crisis. Given the risks posed to the U.S. economy, the FOMC again lowered the federal funds rate over a period of months until events quieted. The 10-year expansion weathered both events with no discernible inflation cost. By the turn of the century, it was beginning to look like financial excesses in global events would pose the main threats to stability in the new era rather than overheating and rising inflation. The collapse of the tech stock bubble in 2000 and the September 11, 2001 terrorist attack played key roles in precipitating a slowdown that turned into a recession. And the next expansion, as we're all painfully aware, ended with the collapse of a housing bubble and the global financial crisis. Thus, this second era provided good reason for optimism about the Fed's ability to deliver stable inflation, but also raised a question about whether long expansions inevitably lead to destabilizing financial excesses. Era 3, 2010 and after. Monetary policy and the emerging new normal. The third era began in 2010 as the recovery from the Great Recession was taking hold. My focus in discussing this era will be on a new normal that is becoming apparent in the wake of the crisis. I will fast forward past the early years of expansion and pick up the story. In December 2015, the unemployment rate had fallen from a peak of 10% to 5%, roughly equal to the median FOMC participants' estimate of the natural rate of unemployment at the time. At this point, the committee decided that it was prudent to begin gradually raising the federal funds rate based on the closely monitored premise that the increasingly healthy economy called for more normal interest rates. The premise was generally borne out. Growth from the end of 2015 to the end of 2018 averaged 2.5%, a bit above the 2.2% rate over the previous 5 years. The unemployment rate fell below 4%, and inflation moved up and remained close to our 2% objective through much of 2018. This brings us to 2019. Before turning to issues occupying center stage at present, I want to address a long-running issue that I discussed here last year, tracking the stars that serve as guideposts for monetary policy. These include the natural rate of unemployment and the natural rate of interest. Unlike celestial stars, these stars move unpredictably and cannot be directly observed. We must judge their locations as best we can based on incoming data, and then add an element of risk management to be able to use them as guides. Since 2012, declining unemployment has had surprisingly little effect on inflation, prompting a steady decline in estimates. Standard estimates of the normal rate of interest rates declined between 2 and 3 percentage points over the past 2 decades. Some argue that the effective decline is even larger, incorporating a lower value into policy. The significant fall in the real rate of interest, however, may demand a more fundamental change. A lower rate of interest combined with low inflation means that interest rates will run, on average, significantly closer to their effective lower bound. The key question raised by this era, then, is how we can best support maximum employment and price stability in a world with a low neutral interest rate. Current policy and the 3 key questions. Let me turn now to the implications for monetary policy of the questions raised by these 3 eras. The first era raised the question of whether the Fed can avoid excessive inflation. Inflation has averaged less than 2% over the past 25 years, and low inflation has been the main concern for the past decade. Low inflation seems to be the problem of this era, not high inflation. Nonetheless, it's unlikely event that signs of too high inflation return. We have proven tools to address such a situation. The second era's question, whether long expansions inevitably breed financial excesses, is a challenging and timely one. Hyman Minsky long argued that as expansion continues and memories of previous downturns fade, financial risk management deteriorates and risks are increasingly underappreciated. This observation has spurred much discussion. At the end of the day, we cannot prevent people from finding ways to take excessive financial risks, but we can work to make sure that they bear the costs of their decisions and that the financial system as a whole continues to function effectively. Since the crisis, Congress, the Fed, and other regulatory authorities here and around the world have taken substantial steps to achieve these goals. Banks and other key institutions have significantly more capital and more stable funding than before the crisis. We comprehensively review financial stability every quarter and release our assessment twice a year to highlight areas of concern and allow oversight of our efforts. We have not seen unsustainable borrowing, financial booms, or other excesses of the sort that occurred at the times during the Great Moderation. And I continue to judge overall financial stability risks to be moderate. But we remain vigilant. This leaves the third question of how in this low real rates world the Fed can best support the economy. A low neutral interest rate presents both near-term and longer-term challenges. I will begin with the current context because today's setting is both challenging and unique in many ways. It may be useful to lay out some general principles for assessing and implementing appropriate policy to describe how we've been applying those principles. Through the FOMC's setting, the federal funds rate target range in our communications about the likely path forward for policy and the economy, we seek to influence broader financial conditions to promote maximum employment and price stability. In forming judgments about the appropriate stance of policy, the committee digests a broad range of data and other information to assess the current state of the economy, the most likely outlook for the future, and meaningful risks to that outlook. Because the most important effects of monetary policy are felt with uncertain lags of a year or more, the committee must attempt to look through what may be a passing development and focus on things that seem likely to affect the outlook over time, or that pose a material risk of doing so. Risk management enters a decision-making because of the both uncertainty about the effects of recent developments and the uncertainty we face regarding structural aspects of the economy, including the natural rate of unemployment and the neutral rate of interest. It will at times be appropriate for us to tilt policy one way or the other because of prominent risks. Finally, we have a responsibility to explain what we are doing and why we're doing it to the American people, and their elected representatives in Congress can provide oversight and hold us accountable. We have much experience in addressing typical macroeconomic developments under this framework, but fitting trade policy uncertainty into this framework is a new challenge. Setting trade policy is the business of Congress and the administration, not that of the Fed. Our assignment is to use monetary policy to foster our statutory goals. In principle, anything that affects the outlook for employment and inflation could also affect the appropriate stance of monetary policy, and that could include uncertainty about trade policy. There are, however, no recent precedents to guide any policy response to the current situation. Moreover, while monetary policy is a powerful tool that works to support consumer spending, business investment, and public confidence, it cannot provide a settled rulebook for international trade. We can, however, try to look through what may be passing events, focus on how trade developments are affecting the outlook, and adjust policy to promote our objectives. This approach is illustrated by the way incoming data have shaped the likely path of policy this year. The outlook for the U.S. economy since the start of the year has continued to be a favorable one. Business investment and manufacturing have weakened, but solid job growth and rising wages have been driving robust consumption and supporting moderate growth overall. As the year has progressed, we have been monitoring three factors that are weighing on this favorable outlook: slowing global growth, trade policy uncertainty, and muted inflation. The global growth outlook has been deteriorating since the middle of last year. Trade policy uncertainty seems to be playing a role in the global slowdown and in weak manufacturing and capital spending in the United States. Inflation fell below our objective at the start of the year. It appears to be moving back up closer to the symmetric 2% objective, but there are concerns about a more prolonged shortfall. Committee participants have generally reacted to these developments and the risks they pose by shifting down the projections of appropriate federal funds rate path. Along with July's rate cut, the shifts in the anticipated path of policy have eased financial conditions and help explain why the outlook for inflation and employment remains largely favorable. Turning to the current context, we are carefully watching developments as we assess their implications for the U.S. outlook and the path of monetary policy. The 3 weeks since our July FOMC meeting have been eventful, and especially after today, of course. Beginning with the announcement of new tariffs on imports from China, we have seen further evidence of a global slowdown, notably in Germany and China. Geopolitical events have been much in the news, including growing possibility of a hard Brexit, rising tensions in Hong Kong, and the dissolution of the Italian government. Financial markets have reacted strongly to this complex, turbulent picture. Equity markets have been volatile. Long-term bond rates around the world have moved down sharply to near post-crisis lows. Meanwhile, the U.S. economy has continued to perform well overall, driven by consumer spending. Job creation has slowed from last year's pace, but it's still above overall labor force growth. Inflation seems to be moving up closer to 2%. Based on our assessments of the implication of these developments, we will act appropriate to sustain the expansion. With a strong labor market and inflation near its symmetric 2% objective. The three questions in the longer run. And I'll go ahead and summarize the end of this. We're at it about an hour. Bottom line is the Fed is going to lower rates and gear up to start supporting the bond market. And so depending on how exciting the trade war gets, we may be in for a huge bubble that will only be ended with sharp inflation. And in fact, all these Fed speakers are now talking about how they want to overshoot their inflation target, which means rates are going lower bond market will potentially be supported with the next round of QE, and we're going to see potentially the great decoupling of the U.S. economy to the Chinese economy. Chinese seem pretty much happy to lose the U.S. as a key trading partner and replace it with the Eurasia territories, where they can continue their closed system, continue their communist government structure, and go on. And I think that they're going to do as little as they can to create some sort of aggressive attack from the United States. So we'll see how aggressive Trump is this evening. That's why we have the put option underneath the SPY. In general, though, I think the government is going to increase spending dramatically, take advantage of low interest rates that are likely heading lower, and this will goose the GDP. It will help the consumer. It'll help the U.S. corporations continue to have great profits. And I think the lag of the recession happening around the globe will not hit the U.S. markets just yet. So we could continue to see this overall trend of money flooding out of emerging markets, out of Europe, and finding the last safe haven. The strongest spot in the markets is the dollar, the U.S. bond, and the U.S. equities. So that's my outlook right now. Let's see how we're doing on the SPY. So we're sitting right at the 286.50 put we sold, or rather purchased today. Let's take a look at that open interest. So yeah, my main concern for being overly short the market going into the weekend is sure that the Trump speech could be dramatic and cause even more sell-off. But at some point today, these positions must be covered. They expired today. They represent something like $5 billion in purchasing. And so most likely, the underwriters who are underwater, they're losing money on these short puts. And this is a lot of money they're underwater. Quite likely they're going to come in, buy up a lot of SPY as fast as possible near the close of the day, and then close out those shorts. And that's what I'm expecting to happen at some point today. Now, what they do after they buy up the SPY shares, who knows? We got to see what happens this evening. And this is an exciting time to be alive. Let's see if we got any questions out there. We got 15 people watching live. That's a new record. This replay will go out to everybody. Any other questions out there? You have your little chat box. And again, our portfolio, even though the SPY went down today, we took a little hit on that. The bond portfolio did its job. If you follow our overall strategy, which I will review again, it's very hard to have a losing period. Now, if we do go back to that period of time where we did have hyperinflation, this strategy wouldn't work because both the bond market and the stock market crashed. Just want everyone to know that, well aware of that period of time, and we know how to profit from that. I just think we're way early in calling the end of the bond bubble. The U.S. most likely needs to go to zero before we could even assume the bond bubble is near the end. Once we get to zero, I think the Fed will start to have to support that bond price. And the thing that will really end the parade will be when we start to see inflation. And you can bet that the stock market will predict that well ahead of the inflation actually hitting. So, crazy time to be alive. Hopefully those of you who are following our program are doing very well. For those of you who've just been watching, I hope you didn't lose too much money today. Call Dean. Let's get you set up. You really need to follow the full program so you have equity exposure, bond exposure, plus a nice hefty gold position. If a trade war, de-escalation were to happen, all of these different principles can reverse. We'd want to get out of the bonds, out of the precious metals. If it is escalating and doesn't escalate too much, I think our current setup to be long stocks, bonds, and gold at the same time is going to do very well. And as we see the fluctuations in the two main assets, it'll balance out and create this very smooth profit. So again, here's a look at our total portfolio returns once you do follow both programs instead of just one. And we're up 1.3% in August. Not too bad. Let's see how that looks on an individual position. So if you're just following the equities portfolio, it's up 8.5 to date this year. It's down to 0.1%, but remember we have that put, so we're probably up a little more than that. This doesn't show the P&L of the options till they close. Our Facebook trade taking a little bit of a hit. Now this portfolio is geared to have bigger returns and bigger losses. We'll be flipping out of, well, we'll see. We got to see what happens this afternoon to decide whether we switch to silver in the equities portfolio on Tuesday or if we want to continue being long equities. The precious metals portfolio is having a nice gain this month, up 3.9%. We just added a lot of cash to this portfolio yesterday. If you watched that live stream, I showed you how we added 50 grand to that position and simplified it to just be long GLD and Bitcoin. Speaking of which, let's just take a look at Bitcoin. Rallying a little bit. I am suspecting Bitcoin is going to go to 20K as long as this trade war escalates, and then I'm expecting people to start dumping Bitcoin and jumping into coins like Ethereum. Ethereum's all-time high back in 2017 was 1,100. So this has almost a potential, 800% gain to get back to the top. But I think we're a little early on that. And if we look at our bond portfolio, it's having a great month, 2.9%. So that's a wrap. If you have not upgraded, please call Dean. It's Friday. Great day to upgrade. Give him a ring at 505-322-7515. Next trade alert will be Monday. And again, normally I don't reveal the position, but today's a crazy day. I'll review the trade alert one more time for all the people following live. We did not sell a call option today. We only bought a put. So if we're wrong, our loss is set in stone. We can't lose more than what's illustrated on this graph. For those of you following, you probably got the put option a little bit cheaper because it did start to rally right as I was putting the trade alert down. Now, depending on how high the SPY could rebound when all these people cover their positions, that's what our potential return is just from now until Monday. So that's the play on this program. We remained long the bond position, even though it looks like we were gearing up for a big equities rally. And good thing we did that. That's how the bond portfolio delivered a nice profit today. And that's a wrap. So thank you guys for your time. Hope you have a great weekend. We'll be covering all the news about Trump on the Monday live stream. And that's a wrap.